If you want to understand how professional traders actually approach the market using smart money concepts, instead of relying on random strategies or confusing analysis, this video will give you a clear starting point. We are going to break down the fundamentals of fair value gaps and how they form in real market conditions. To begin with the fundamentals, a bullish fair value gap is the area between the upper wick of the first candle and the lower wick of the third candle in a three-candle formation. In the same way, a bearish fair value gap is the area between the lower wick of the first candle and the upper wick of the third candle. Candle color does not matter, and these gaps can appear in different shapes and sizes. But what do fair value gaps actually tell us about price behavior? A bullish fair value gap represents a buy-side imbalance, meaning buyers were stronger than sellers, often driven by large institutional activity. This creates an inefficient move in price, and the market will often return to the fair value gap area to fill or mitigate it. The same principle applies in a bearish scenario. As smart money traders, identifying fair value gaps is one of the first things we do when opening a price chart. But why is it so important to mark them clearly? Fair value gaps highlight areas where major market participants entered with strength and pushed price aggressively. When price revisits these zones, we often see reactions that can lead to high-quality trading opportunities. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's get started. On the pound-dollar 1-hour chart, price tapped into a bearish fair value gap and then continued moving lower. After that, another fair value gap formed and price once again rejected to the downside. On the euro-dollar 1-hour chart, you can see how price reacted multiple times to a fair value gap before the reversal finally occurred. This concept works across all time frames. Even on the daily chart, price forms clear fair value gap zones. This specific gap was created by strong buying pressure and sustained upside momentum throughout the session. We expect price to eventually revisit this fair value gap and offer a potential long opportunity. However, for a day trader, this area is simply too wide to trade effectively. Because of that, we need to drop down to lower time frames and refine it. Refining a fair value gap means moving to a lower time frame to locate a more precise fair value gap within the larger zone. For instance, when we zoom into the 4-hour chart, we can identify a 4-hour fair value gap sitting inside that broad daily area. This transforms a wide daily imbalance into a much tighter and more accurate zone to work with. This refinement process is not exclusive to fair value gaps. The same approach can be applied to order blocks, supply and demand zones, and other key areas. Now, before we decide which fair value gap is actually worth trading, we need to step back for a moment and understand what is really driving price into these areas. Because fair value gaps do not work in isolation. Price does not move randomly from one zone to another. It moves with a purpose, and that purpose is liquidity. So, to make better decisions and avoid low-quality setups, we first need to understand how liquidity behaves in real market conditions and how smart money interacts with it. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap, Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional, it is essential. These zones, where orders are concentrated, reveal how the market is likely to behave and help you avoid unnecessary losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let us break both down in a practical way. Dynamic liquidity relates to the forces that drive price movement. In simple terms, it reflects how price flows through structure. To visualize this, think of a typical market swing with a defined high and a low. These highs and lows represent external liquidity. External liquidity refers to the liquidity resting beyond key swing points. On the other hand, the fair value gaps within that range represent internal liquidity. Price is constantly moving between these two types. In practice, the market cycles between internal and external liquidity, moving from one to the other in a continuous flow. Looking at this schematic figure, we can see a rally wave moving upward, sweeping the external liquidity above the previous high. After that, price shifts toward internal liquidity, represented by a fair value gap, to rebalance inefficiencies left behind. From there, price transitions again toward external liquidity. In essence, the market moves from internal to external liquidity, then back again. Once external liquidity is taken, price often seeks balance by returning to internal liquidity, filling the most recent gaps. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Static liquidity can be identified in several recurring areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within or around order blocks. It is also present around support and resistance levels, Fibonacci retracement zones, and near the body and wicks of daily candles. When you consistently recognize these zones, you begin to understand how strongly they influence price direction. Ignoring them often leads to unnecessary losses. Some of these areas attract more attention than others, especially those widely recognized by traders, which leads to a concentration of stop losses and pending orders, increasing the probability that price will move toward them to capture liquidity. So now, when you look back at fair value gaps, you can see that they are not just random zones on the chart. They are areas where price is likely to react because of how liquidity is positioned around them. And this leads us to the next step. So now the real question becomes, which fair value gap is actually worth trading? In this example, there are several fair value gaps marked on the chart. The basic idea is to wait for price to reach these zones and then look for buying opportunities. However, we are only focused on buying when price reaches the middle fair value gap. So why are the others ignored? If we take the beginning and the end of the most recent impulsive move and apply the retracement tool, you will see that the second fair value gap sits below the 50% level, which defines the discount zone. The other fair value gap is positioned above the 50% level, which places it in the premium area of the range. We only look for long trades in the discount zone for several reasons. In most cases, the market tends to remove early buyers. Waiting for price to reach the discount area provides a safer long entry, increases the probability of success, and lowers the risk of becoming a liquidity target. No matter where we take a long position, the safest place for the stop loss is always below the swing low. Because of that, we want our stop to remain as close to that level as possible. At the same time, Our first target is the most recent high. So if we enter from the first fair value gap, there is simply not enough space to achieve a proper reward. This approach works best when the market delivers deeper retracements. The reason we're not interested in buying from the lower fair value gap is that if price breaks below the swing low, market structure turns bearish. In that case, any long position would be trading against the trend, unless we clearly identify that break as a liquidity grab, where price may still continue higher. The same principle applies when we analyze a bearish scenario. The fair value gap fits inside a complete trading setup. This trading plan is built around two main time frames. First, we analyze the higher time frame, where most of the contextual work is done. Here, we study market structure to define direction, key levels, liquidity zones, and most importantly, fair value gaps, which act as optimal trading areas and can offer high-quality setups. In the second step, we move down to the lower time frame to look for confirmations and execute our entries. Remember, this trading plan is not restricted to any specific market or time frame. However, your execution time frame must always be 2 time frames lower than your higher time frame. Based on your trading style, there are 3 time frame combinations you can use. For example, if your higher time frame is the 4-hour chart, you should drop down to the 15-minute chart to execute your trades. As mentioned earlier, this trading plan is simplified into 2 main stages. So let us start with the first stage, analyzing market structure on the higher time frame. In this broader analysis, we apply smart money market structure concepts to define direction and key levels. To determine direction, we look for breakouts, reversals, and liquidity sweep behavior. Everything will be marked manually on the chart. We will identify break of structure, change of character, and liquidity sweeps using pure price action. This is a core skill every trader must build, learning to read and mark the market by hand. Now we can observe multiple breaks of structure to the upside, which tells us the overall directional bias is bullish. After that, the market creates a liquidity sweep above the previous high, pointing to a possible reversal. This move is later confirmed when price breaks and closes below this low, forming what we call a change of character plus. This occurs when price fails to print a new high and then breaks the swing low to the downside. This behavior shows that buyers were unable to hold control and sellers have stepped in. A bullish liquidity sweep occurs when price moves below a key area, triggers stop losses, and then quickly reclaims the range. When this happens, we anticipate a move to the upside. In the same way, a bearish liquidity sweep takes place when price reaches above a swing level, engages liquidity, and then rapidly drops back below the range. When this occurs, we expect a move to the downside. Now remember, if you're not able to clearly define market structure and direction on your chosen time frame, it is better to move on to another asset. When direction is unclear, the likelihood of making poor trading decisions increases. Shifting your focus to a market with a clearer trend helps you remain disciplined and objective. The final step of higher time frame structure analysis is identifying high-quality fair value gaps to trade. We mark these fair value gaps manually using pure price action. The goal is to focus on the most relevant and recent gaps without cluttering the chart. By filtering out smaller, less significant imbalances, we are left with clearer and more meaningful zones. Once the optimal trading area is identified, we wait for price to reach that zone and then drop to a lower time frame to look for reversal confirmations and execute the trade. This is the overall logic behind the trading plan. Here's the checklist of concepts we apply on the higher time frame. Now, the second part of this trading plan is to wait for confirmations and execute the trade on the lower time frame. After price reaches our trading zone, we need to see clear signs that the short-term upward move has ended and that price is prepared to move lower. To spot this reversal, we focus on liquidity sweep behavior and shifts in market character. A valid liquidity sweep above the previous high suggests that a potential reversal is developing. At this point, you can enter a short position, place your stop loss above the high of the liquidity sweep candle, and aim for the key levels ahead of price. For a more conservative entry, you can wait until price breaks below the recent low to confirm the change of character. Once the reversal is confirmed, we then wait for price to create new fair value gaps. This is why the strategy is referred to as FVG and FVG. This does not mean that the lower time frame fair value gap must sit exactly inside the higher time frame gap. The key idea is that the higher time frame gap defines the optimal reaction area, while the lower time frame gap offers precise entry timing after confirmation. Once an FVG appears on the lower time frame, we place our sell limit at the start of the gap and position our stop above it. For the first target, we reduce risk by closing half the position at a 1-to-1 target and moving the trade to break even. The final target is the first major zone ahead of price on the higher time frame. Now, before we look at real chart examples, I want to go over some common situations that appear on the chart and how to deal with them. In the first case, we have a very small fair value gap. When this happens, it's better to use a slightly larger area for your stop loss, so it's protected from normal price fluctuations. In the opposite case, we may see a very large fair value gap on the lower time frame. The problem here is that placing the stop below this zone would lead to an excessively large stop loss. In this situation, we can either use a smaller area below the fair value gap as our stop, or place our buy order closer to the middle of the zone. By doing this, the risk to reward profile improves significantly if the trade becomes profitable. Now let us move on to some real chart examples. On the Euro-Dollar 1-hour chart, price was in a clear downtrend until we observed a liquidity sweep followed by a change of character. Both signals suggest that sellers have lost control and that our directional bias has shifted to bullish. On this chart, we can identify two fair value gap areas, but only the one located in the discount side of the range is considered a valid trading zone for us. After marking this area, we simply wait for price to return into the fair value gap and then drop to a lower time frame to search for long trade opportunities. When we move down to the 5-minute chart, we can see price forming a change of character by breaking above this level, which serves as our confirmation and reversal signal. At this stage, we identify a new fair value gap on the 5-minute time frame and place our buy order at the start of the zone. We then set our stop loss below it and target the next key area ahead of price. Now, let us see how this trade develops. Next, on the Canadian dollar versus Japanese yen 1-hour chart, we can observe a clear downtrend with several fair value gaps present. However, after applying the retracement tool, only one of these zones qualifies as valid supply based on our rules. Once the trading zone is marked, we wait for price to retrace back into that area and then drop to a lower time frame to execute the trade following our plan. On the 5-minute chart, price forms a change of character together with a fair value gap, which gives us our entry setup. We place a sell order at the start of the fair value gap zone and position our stop loss above it. As you can see, this trade ends as a winner. Still, losses are a natural part of trading. No matter how solid a strategy is, losing trades will happen, and a loss does not mean your analysis was incorrect. What matters most is having clearly defined rules, respecting them, and applying proper risk management. When you do this consistently, the long-term results take care of themselves. Before we wrap up, Notice that fair value gaps only become effective when they align with proper market context. The higher time frame defines direction, while the lower time frame refines entries and confirms the move. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.